Hey guys, I hope you guys are trading well here and you're all paper trading. I hope you've all paper traded before you started actually allocating real money to trades. I have a very special presentation today. Basically, there are four risks to this type of business, and I'm going to share all four risks with you today. These risks are something that you really need to keep an eye on as you develop your business. They're not something that are terribly intuitive, but these are the things I've learned while doing this business and by creating these business opportunities. When creating a business, an investment business, we manage, remember, by the numbers. The numbers are everything. Now, every business understands what their product is. You have to have a very good, firm foundation of understanding what your product is. In this business, your product is calls and puts. Okay, this is the stuff that we deal with, the product that we deal with. We're selling options and we are buying options. We are a business that buys and sells. Anytime you're in business, you have risks. The four risks that I'm going to talk about today is concentration of risk, overlapping trades, allocation of capital, and finally overtrading or over adjusting positions. Let's take the first one, concentration of risk. What I mean by concentration of risk is that you have almost all of your profit potential centered around a single strike price. For example, I have currently on the screen our portfolio with the symbol IWM, so it's weighted against the IWM. As you can see, we have a fairly wide range in which the IWM can move and we could still profit from this position. And if we dig down into this position, I can show you that we have a lot of different positions on. There are all kinds of different positions here. Concentration of risks means that, let's say at the 73 strike price, you have a very large position at the 73 strike price. You sold a number of calls, and I guess size all depends on the capital that you've allocated for this business. But let's say $5,000 is a lot of money to you. Well, if you have $4,000 of your money tied up in margin, and they're all centered around the 73 strike price, whether you've sold them as calendars or you've put on different types of spreads or a sale of a vertical spread. If you have all of your risk concentrated around the 73 strike price, what you're doing is you're concentrating your risk at that point, so that if prices move way down or they move way up, you're probably not going to have the same type of profit potential as if you had a wider range in which you could profit from. So that's concentration of risk. Concentration of risk means having a lot of contracts or size position for you, and that could be, if your capital allocation for this business is $5,000 or $20,000 or $50,000 or $100,000 or $500,000, it doesn't matter. If you have a large position that you would consider large at a single strike price, you have concentration of risk, and that's very dangerous. Prices can move dramatically against you very, very quickly, and if you have a concentration of risk at a particular strike price, you're going to get hurt. The second thing I want you to be aware of is something called overlapping trades. Let's take a look at our inventory again for the IWM. As you can see, we have a number of different positions here. We've sold, most of these are calendars and double calendars, so we have the 67 put in May, we're short 2 of those, we're long 2 of the 67 puts in June, we're short 2 of the 70 calls here, we're long 2 of the 70 calls in June. So there's lots of calendars here, but you can see that they are all basically at different strike prices. And they're different options. One's a put, one's a call. Let's say you had an idea for an adjustment and you were running up against your break-even points on your profit picture, and you decided that you were going to go ahead and do an adjustment in which you were going to buy 4 of these 67 puts and perhaps sell 4 of the 69 puts. So you were going to do this for a credit. On the surface, it sounds like a pretty good idea, but here's what's going to happen in reality. Since you are short 2 of these 67 puts, and you buy 4 of them to protect your short 69 put position on a vertical spread, then you're actually, what you are doing is having a net positive 2 67 puts. The 4 that you're buying will eliminate the 2 that you're short, and you'll have a net 2 67 puts in May. That will have unintended consequences for your position. And unfortunately, Thinkorswim's platform will not alert you to the fact that you are overlapping positions, that you have an overlapping position. Now your calendar is no longer a calendar because now you're no longer short those 67 puts. You're not short those 2 puts anymore. Instead, you're long 2 of those 67 puts. Not only that, so your calendar is now no longer in operation, is not active for you, but also you are long 2 67 puts when you really wanted to be long 4 67 puts to protect the 4 that you're short on as the 69 put. It's a very important concept to understand, is that when you adjust your positions, if you're short some puts and you add 4 long positions to the same option, then in fact you are net a different position. And it's very important that you understand that, and the analysis tab may not help you with that. It's not going to pop up a little box saying, oh, by the way, you're short 2 of those 67 puts. If you buy 4 of those to protect your short 69 puts, you're going to be net long 2 puts. Very important concept to understand. So when making adjustments, make sure that you take a look at your trade tab. Look and see where your existing positions are, and if you're short those positions, make sure you do not go long on those positions, basically negating your current position. The third thing I want to warn you about, and the third risk of really this type of business, is the allocation of capital. Allocation of capital means that you have so much capital available to you. In this case, we have, in this demo account, we've allocated about $28,000. Our total, all of our cash is about $230,000, but our actual position for this account is $30,000. Even if you had $200,000, you don't want to spend $230,000 on opening these positions. If you have $20,000, you do not want to use all $20,000 opening these types of positions. If you have $5,000, you do not want to use all $5,000 opening these types of positions. The reason for that is just like any other business. Any other business, if they had an opportunity to buy stock, let's say they had a gift store. If they had an opportunity to buy stock to put in their store at a very, very low cost, but this opportunity is only available just for a few days because there are other people who are interested in this stock. But you could get it very, very cheaply, maybe 50% cheaper than you could normally buy it. You would need the capital available to make that purchase as the opportunity became available. So that's what we need to think about in this business. When our prices start to run up towards our break-even points in our portfolio, we need to make changes to our business so that we have the capital available to take advantage of those opportunities, because many times a position that runs up against our break-even points is an opportunity to add to our current positions. It's a smart allocation of capital to take advantage of those opportunities. Not only that, but you could think of it as in this way too. You could not only are the opportunities, but also it's an indication that our trade is broken. If you owned a restaurant and you had let's say you had a deep fry cooker, and you had and it broke, and your business really depended on that piece of equipment, well, you would have to have the capital available to go out and purchase that piece of equipment. It's very important that you have that piece of equipment to continue running your business. If you didn't have the capital to purchase that piece of equipment, it's possible that you could go out of business. Well, it's the same thing in this business. If you have the capital available to make adjustments to your position when they run up against your break even, that gives you an opportunity to stay in business. If you don't have the capital, you may have to close out the position at a small loss and just call it a day. That's why we don't suggest using all of your capital to initiate positions when we begin building our portfolio. We start our portfolio out on some basic positions, but we always make sure that we have capital available. Working capital in any business is extremely important. We have the working capital to take advantage, to fix broken trades as necessary. For the fourth risk that I want to talk about is overtrading or over-adjusting. One of the principles of this business and one of the truths of the market is that prices fluctuate. Of course, we never know exactly how prices will fluctuate, but we know that they do fluctuate. If we take a look at a current chart of the Dow Jones Industrial Average, you'll see that yesterday we had an extremely large run up in prices. In fact, they were up almost $200 yesterday. Today they were up another $115, but now they've backed down quite a bit. In fact, they backed down to the point where it's below this 200-day moving average, which we had kind of determined to be somewhat of a resistance point, as well as the 13,100 level. Technical analysis is interesting in that it's fairly simple. You have support and resistance points. You have support. You have resistance. You have resistance, and you have support. That's pretty much all you need to know as far as technical analysis goes for the type of business that we run. That's pretty much it. But prices do tend to fluctuate. Sometimes they go up, sometimes they go sideways, sometimes they go down. Adjusting positions becomes really an art of knowing when exactly to make those adjustments. I would say that once you get to the point where any time between your break even and one of your peaks of your profit picture, maybe the final 1/3 or even 1/4 on each side of your profit picture, just before your break even, would be an appropriate time to make an adjustment. If you make adjustments too often, then you're really doing over trading, because prices too tend to fluctuate. They will go up and they will go down. You want to try to keep your profit picture and your price pretty much centered. And if it goes off, maybe you want to do a little adjustment. You don't have to do a large adjustment. In this IWM position, we have actually made a number of adjustments. I like to adjust using the IWM because the spreads are so small. You can see on the Mayo 873 call here, the spread is only a penny. If I had to do another adjustment, I would like to do it here. The same thing on the put side. You can take a look at the 72 put here. It's a 1 penny spread. These spreads are so small that it makes it very easy to make an adjustment in your position and still have a profitable picture. So the IWM is actually an excellent vehicle for making adjustments. Another ETF that's really, really excellent for making adjustments are the Qs, the NASDAQ 100 ETF. Again, the spreads are very, very small. I currently don't have any positions in the Qs, but if I had to make an adjustment, I might use the Qs to add as an additional position if the opportunity became available. So those are the 4 risks of this business, and I think it's important that you understand those risks. I've talked about concentration of risk and allocation of capital, overlapping trades, and overtrading or over-adjusting. But the key point is they're only necessary because of price risk. Price risk means that the price is going to move up and down against you. If there was no price risk, you would have absolutely no problem with concentration of risk. You'd have absolutely no problem with overlapping trades. You would have, because you would not adjust anything. You would have no problem with allocation of capital because you could simply put your positions on at one price and remain there until expiration. And you'd have no risk of overtrading or over adjusting. So all 4 of the risks in this business really have to do with price. Prices will fluctuate sometimes wildly, sometimes moderately, but they always fluctuate. They never stand still. So if it wasn't for price risk, none of these other 4 risks would even be a consideration. But because price is a risk, then we have to really pay attention to these 4 risks. And those are the 4 primary risks of this business. All of them are easily managed. Concentration of risk is easily managed by spreading out, as I've shown you in this IWM position, across a number of different strikes. Now, many of these represent adjustments. But if we take a look at our diamond position, we still have our 1 iron condor position on. We didn't make any adjustments to the diamonds. If we take a look at our SPY position, we had to do 1 adjustment, which was an overlapping iron condor. But that was it. The IWM is actually the ideal vehicle for adjustments because of the spread situation I told you about. There's really an art and a science. The science is the numbers. The art is knowing when to adjust. That's it for today, guys. Hey, trade with confidence.